Good morning, everybody. Welcome to the Flow Show. Morning to my two colleagues, Dale and Kay. How you doing?
Hey, I got first mention. Good morning.
Yeah, now I've got the hump. See you tomorrow, guys.
Okay, I got first mention. I'm going to be showing charts today. Good. How you doing, Ryan, Kay? Everything all right?
Yeah, all good, mate.
Good stuff.
All good, all good. So how does it feel to be 52 in a day?
Good. It was a good day yesterday, so very, very happy.
Yeah, good. Glad you enjoyed it, mate. Back to work for you. Let's get cracking, shall we? Right, PBOC is still trying to keep a leash on the $1, setting their mid rate at 7.1565 versus 7.1869 expected. As you can see, we're sailing pretty now into the 720s, so that leash is being stretched by the guys over there. That hasn't been helped by the data overnight. Chinese data, I mentioned, need to keep an eye on how trade balance numbers come in, whether they're good data or bad data. As you can see, green number, nice data on the trade balance, up over 10 billion more than expected and previously. However, it's not good news because look at these export numbers, down 14.5% versus down 12.5 expected and down 12.4 previously. Imports down 12.4%, completely blasting away the expected negative number and the previous negative number. So again, better trade balance, but on the activity front, not looking very good at all. So this is, again, a clear indication of when good data is bad data in terms of what it means for the economy. So that's helped with the yen weakness that we've seen again this morning, because again it pushes things towards the dovish side, getting PBOC officials maybe loosening the purse strings once again on some of those rates, and maybe even the big RRR, reserve requirement ratio, which is the sort of the biggest rate cut move or stimulus they could do in terms of rates over there. So not very good there. And then later this morning, retail passenger vehicle sales fell by 2.3% year on year. As we've been highlighting on various shows, they are putting in place measures to make it easier to purchase new electric vehicles. That's a big drive that they've got going on over there. But the data so far is suggesting that that's not kicking into gear just yet. So China is still looking a bit weak. Keep an eye on the CPI data that we get tomorrow, or I think it's tomorrow night. Let's have a look. Might be tonight. No, I think it's tomorrow we get the CPI data. That's going to be a big one. Flat number expected year on year for CPI there. If it goes to a negative, again, that's going to likely see the yuan weaken some more and raise expectations for action from the PBOC on rates. Just coming across to Japan now, and household spending. Well, we had a bit of a batch of data out from Japan, and it's some up, some down, some good, some bad. So average cash earnings year on year was up 2.3%, higher than expected, not as high as last month. On the wage, keeping to the wages front, overall wage income of employees was up 2.3%, beating expectations. Overtime pay year on year, much higher as well. However, when you look at it in real terms, real cash earnings were down 1.6%. That's much worse than a down 0.9% expected and previous down 0.9%. So on that front, not too good. On the spending, a decent enough beat of expectations on the month, but still negative year on year. What I would say for a lot of this data, particularly the year on year numbers, and particularly to do with wages, obviously we've had those wage increases coming into the fiscal year. Those numbers are not going to be reflected in the year on year numbers until probably next year. So there's still a bit of wobble. So it's a question of measuring against what last year was, but what we know now in terms of wage hikes. but for all intents and purposes, we know that real cash earnings are still in the negative, which is what the BOJ and the government would like to turn around, helping with their inflation push. Other bit of news is that the Nikkei stock indexes are going to be reshuffled at the end of August. This relates to the Nikkei 400 and the mid-cap indexes over there. So a little bit of a switcheroo going on there. Some companies coming out, some companies going in. Not that I've seen, but I don't think there's anything happening to the 225. You seen anything on that, Kay, in terms of reshuffling?
No, mate, I just saw you mention it this morning. No, I haven't seen anything really.
Yeah, and what do you make of the data?
Mixed, very mixed. But as we know, the Bank of Japan keeps on hammering on those wages. Although there's some green shoots in there. If you look at the current account, pretty okay. If you look at also the adjusted, pretty okay. But then the bank lending numbers are also coming off a little bit. It's real mixed bag, I would say. It's hard to find the trade if you look at those numbers, right? There's a bit for every side. But I don't know if you're going to cover it, but I read something, an article overnight, and Mizuho came out with some really strange comments, in my opinion. But then they're one of the Japanese mega banks, so they should know, saying that out of government debt considerations, Bank of Japan is unlikely to let the JGB yield go above 70 BPs. That is not exactly what they told us on the Bank of Japan meeting, widening it to possibly 1%. But Mizuho came out with that, and in my opinion, that may have harmed the yen perhaps more than that set of data. Yeah,
so they're going to put a almost separate stop in at or brickboard in at 70 rather than the 100.
Yeah, but that's going to be interesting for us as well, because imagine that Mizuho is wrong and we start to trade over 70 BPs. That is likely going to underpin the yen then. But you know, it brings us back to what I said at the start when Ueda got nominated. The government bots were very, very fast in saying that they need a very strong cooperation between the Bank of Japan and the government. And that Mizuho comment brings me right back to what I said at the start, is saying that he's probably not going to be your big reformer. So be careful with yen loans, especially that the funding is still biting, even if the rest of the yields come back down as we see now.
Yeah, I mean, I suppose looking at it in a cold light of day, it's probably something we probably should have expected them to put a bit of a ceiling. I mean, they already look like they're putting a bit of a ceiling in the high 660s, mid to high 660s. I suppose it just gives them a little bit of room to play with, doesn't it? If they get any volatile events, then it can move up to 1%, and then they can start stepping in, rather than letting it go there now and then always having to defend 1%.
Yeah, true. But then if you look at the distance between the prior Bank of Japan meeting and the next one, which is going to be second half of September, there was this possibility that they let it virtually slip 1 BP per day, and that would bring us very close to the 1%. And I reckon when the market saw that and that 1% red line, that the market thought like, okay, this is going to be it. They're going to let it slip, and in September we're going to be trading very close to 1%. Now, if Mizuho is right, and again, who are we to contradict one of the Japanese mega banks? They should know. We are not even going to get there, and that, I think, is somewhere news that people need to take into account.
Yeah, no, I agree with that. Yeah, I think you're right. Roberto's just asking, the weakness in China usually leads to Aussie Kiwi weakness, but we should be careful that this Chinese data might lead to extra stimulus and therefore strengthen Aussie dollar. Yeah, it's 6 of one, half a dozen the other. Usually when you're talking stimulus from China, that usually tends to knock Aussie dollar on the head. a bit because it's easing. So it's acknowledging that there's a problem in China, which is obviously not good for Australia. But on the flip side, yeah, if the market takes it on board that it's a positive move, then that can boost things like the Aussie. Aussie Kiwi's been very funky of late. I don't know what's going on in this one, but it is staying glued to that 108 every time. It will move around and it comes back, move around and it comes back. I don't know what's going on. I've had to look at the options. I can't see any options. I might need to look a bit further out, perhaps. But usually when you see something like that, it can be down to the options, just a lot of strikes around that area, keeping the price glued. But on this front, I don't see any sort of reaction here to the Aussie, to the Chinese data. Aussie dollar might be reflecting that a bit more because it's a bit softer again today. So that might be a factor where we're seeing that China data playing out. But yeah, in terms of stimulus, yeah, you want to see a reaction from it though. And so the market at the moment is siding with the fact that the Chinese economy isn't doing well, as opposed to stimulus will be an immediate injection of positivity. So that's why if you're going to see the Antipodeans moving on China stuff, it's going to be on the negativity side, more so than the stimulus side, I think, for now. But yeah, interesting question on that. So I hope that's given you right. You wrote it like Aussie Kiwi, so yeah, that's how I took it. But anyway, I get your drift. Mate. Okay, coming back to the rest, and Italy done their stock market no favours this morning. The cabinet approved a 40% windfall tax on banks. This is going to be limited to 2023. They announced that late last night, and as you can imagine, Italian banks have been hammered. Their stocks have been hammered this morning. For the ECB, they had a consumer survey out, and inflation expectations over the next year, next 12 months, dropped to 3.4% versus 3.9% in the previous poll. Longer term, 3 years ahead from Q2 2024. So they getting into the higher for longer mantra from the ECB. Over to the Bank of England, and BOE's Peel has been out again. He was out over the weekend, or Friday, I think it was, and this time he said inflation in the UK remains too high, much too high, and a lot of the rate hikes yet to hit the economy. There's lots of news since May on the inflation persistence. He also said in his prior comment that there was a risk of them doing too much, and he's gone the other way on that, saying that there's also risks the UK hasn't raised rates enough. So he's well and truly on that fence. It says the latest data points to more persistent inflation, and by his tea leaves and the seaweed hanging in his shed, he says inflation is likely to fall to 5% by the end of 2023, but not likely to return to target until the first half of 2025. Good luck to them. These lot can't predict the sun coming up in the morning, let alone what's happening in a year and a half's time. Anyway, over to the good old Yanks, and we had some data out last night. US consumer, where are we going? What day are we in? Oh, I'm lost. US consumer borrowing. Where is it? There we go. Consumer credit, and quite a large jump, 17.85 billion over the 9.46 billion previously. A lot of this was in non-revolving credit, and that non-revolving credit refers to things like student loans, mortgages, car loans, because they are one-off loans, i.e. you can't sort of dip in and out of them. Once you've taken them, you're locked in until you've paid it off. So that saw the bulk of the jump in that consumer credit. Credit card and other short-term debt, that's revolving credit, that's what it's called in the report, actually fell by 600 million, the first drop since April 2021. So things work a bit differently in the US. Credit card is used as a means for everyday spending, whereas here in the UK we use debit cards, and credit card is used for putting stuff on to pay off later. So it's used slightly differently. But still, short-term credit falling suggests that there isn't any big issues in the US in terms of borrowing. If that starts to skyrocket, because that shorter-term debt obviously carries higher interest rates, which have done nothing but go higher as the Fed hiked. So if we start seeing those numbers increasing significantly, then we might need to wave some flags about. But otherwise, a lot of car buying was happening in the US, hence why the non-revolving credit, car loans, etc., had a big jump over there. So still points to solid consumer spending over in the US, which is, again, something you want to watch for if we're going to start seeing rate hikes bite and the economy stuttering. There's also more, well, you're going to love this, more impending shutdown fears for the US government. Apparently they've all buggered off for their summer jollies, leaving lots of little bits and pieces and bills and stuff undecided, which means that potentially by October we could be facing the same old shutdown fears if they don't get all these bills passed. It's all to do with the bigger deal that they agreed several months ago, and this is all the bits and pieces and laws and different parts that they need to agree and put through for that bigger solution to kick in. So they haven't done that in time for the summer recess, so it's going to be a bit of a rush job when they all come back. So hopefully not, they'll get all that sorted and we won't have to go through all the shutdown gear again, which is always fun. You guys got any comments on any of the bits and pieces there, or anything you want to bring to our attention?
No.
Okay. I'll take that. Kate, got anything?
Well, I found an interesting post of yours in the newsroom this morning on the inflation in the Eurozone, and I just would want to say that I think once those base effects that the people were expecting, especially like Germany and stuff, are probably going to wane come September or so, and I want to make the call, and you can timestamp it, that from September, October, the inflation in the Eurozone will likely accelerate to the downside. That's what I'm starting to think right now. On the other front, there's I think you've covered everything, mate. Covered everything.
Yeah, cool, mate. I think we need a timestamp board to put all these pin all these notes up, because I've still got inflation going to have a little bit of a dive perhaps from this month for July's data, and now you're pinning on September, October for the ECB or Eurozone inflation dip. So yeah, we need a pin board so we can see how we're done and keep an eye on these things. Yeah, but I'll probably agree with you, actually. There is a lot of stuff that needs to wash out of the inflation data. You know, there's things that are still high, food, stuff like that, but we've had a long period of lower energy prices, which is already starting to fall out. But you know, that's been, you know, take oil for example, been down. Let's get the chart up, and we'll take a look at the Brent side of things. So we've been, you know, pretty much for all of late 2022, 2023, we've been in a pretty subdued range, and that's probably only just now going to start feeding into inflation, which is still containing prices when we were up here. So that's one of my reasons why I'm thinking that the BOE or the UK is going to get a bit of relief, and the same is likely to happen to the Eurozone as well. So yeah, and they're a bit more laggy in the Eurozone, seeing as it's you know, how many is it now? 17 countries or 19 countries or 18 countries? I don't know how many's in the Eurozone these days. They come and go as they like. Too many. Just should be just Greece and Germany, eh? But yeah, so I agree. Is it 15? Did you say?
19.
19 is 19. Yeah, I remember that. Who went in? Croatia, was it? No, I lose count, as I say. I'll have to Google it. Don't worry about it.
Estonia.
Right. Horatio just asked on euro sterling, is it suitable to be long euro sterling seems to be holding the 86 handle. So let's have a quick butchers at that.
The interesting bit in that is the word suitable. I like it very much, Horatio.
Is it suitable? Well, if it suits you, sir, then it is suitable. Yeah, I mean the 86 level, 86.10 is a bit of an area. I personally wouldn't. I'm not looking at it as a possible support area to go long. You've already had one test here. We've had a little bit of a bounce. The bounces are looking a bit weaker now. You know, we've got this initial move up through it, and then we got all the way up to you know, the 86.50s and the 86.60s. Then we came back to it. Then we bounced to 45s, 48s. Then we've come down again and we've bounced, only got as far as 20. So if you're looking to buy off of this 86 handle, I'd be a bit cautious, just because of the way the previous bounces have reacted. If we come back down to 86 now, that'll be a pretty quick move down from the last test, and I don't like it when we get too many knocks on the door, even in the short term. I mean, certainly if you want to try the level, but you'd probably need to keep your stock fairly tight. You know, anywhere under 90, you're probably looking at maybe taking a loss. If you've got the patience, you could wait, see if it breaks down here. You know, you could always go half a size trade in case it holds, and then add a bit more if it doesn't. You can widen your stop, widen your trade for the same amount of risk as you would just putting the whole trade on at 86. If we do get a move under, then you're probably going to be looking back down towards this 70-50 zone as your next support level, which has proved pretty solid. I mean, you've been following us here for a while. I've been waiting for another move down to 85, but it's just not got there. 85, 50s. Even with that little extension, 50s is still the main number. So it's up to you how you cut it, Horatio. But I would be careful if you've got another quick test here of 86. If you are going to try long, keep it small, keep it light, just in case it does break through. I'd rather make a little if I'm right than lose a lot if I'm wrong. Just the way you've got to look at your risk factor. But anyway, Horatio, yeah, you've got patience. Good for you, my friend. Good for you. So, yeah, that's my thoughts on euro sterling. I'm still sitting in my long on this one, twiddling my thumbs. I want to get a break of that 87. And the longer it goes on, the more I'm inclined to then add a buy stop in above probably 87.20, because I think if it does break eventually, it's going to rip a bit, probably to 87.40 in that rip. No, I think we'll probably get 88 not long after that if it does break. But summer months, so yeah, you might have a big waiting game for this one. Stel, what have you got on your magic list today?
Well, I would barely call it magic, but I can have a look at a few things. Obviously, let me take the screen first. We are waiting for the big one, biggest inflation report since since Moses. But Thursday CPI is important. We're expecting a 0.3 rise, and this is mainly because we are getting rid of a month of zero inflation and adding a month of X, where X is the unknown. I still think for choice the number is going to disappoint, and that's been my view for quite a few months now, and I hate to say it, but it's been right. So I still think this will be the case, most likely. And of course, the Fed is looking at inflation like a hawk, and they want to see it continue to come down. Now, the thing is, let's have a look at this actually. So this week, the thing is that nothing goes in a straight line. We've talked about this. So here we go. So it's been an orderly rise in inflation. Remember, this is the post-COVID era. Also, the Ukrainian war. So a lot, two big factors adding up to higher inflation. So it was a pretty nice and steady rise, and it's an even prettier nice and steady fall. the thing though is nothing goes in a straight line. Even on this area here, when it was rising, it dropped for a couple of months, etc. It's been a one-way ticket now. So for this to kind of bounce a little bit, of course it can happen. I still think price pressures are going to be subdued. That doesn't mean, again, I'm going to repeat this another time, it doesn't mean that things are back to normal in any way. It just means that the rate of change of prices going up is slowing down, which is a terrible thing for consumers because disposable income has been decimated. And this you can see from numbers in the US, like credit card spending, which is going through the absolute roof. So with my view being that inflation is going to have a very hard time going higher, at least not in the short term, like in the next 6 to 9 months, like I've been saying for a while. And with central banks stopping their tightening, and with some actually starting to cut already. And remember, the Fed, they are already giving almost like guidance that in a year's time, yes, we'll probably be cutting. And that's how it starts. You know, you guide a year in the future, and then you bring it forward, don't you? So in this scenario, I find it hard to see how yields can keep going up. And I've been saying this for a little while now, for a couple of weeks probably. And I think we are now at a point where we will have likely seen the top, at least for this cycle. So we'll look at 10-year US, and it's down today again. It's 20 basis points off the highs. But really, we have to get through this area here, which is around 380, 370 to 380. I know it's 20, 30 basis points away, but it's coming, I think. And I think after that, we go to test 330. And if you want my honest opinion, I think we then go towards 250. But that's a different story. Nobody can forecast that far out. And if they say they can, I think they're talking crap. Pardon my language. So I think yields are coming down, which theoretically should mean that the dollar will follow suit. And I am still looking for a little squeeze up to this 103, 103.50 area for the Dixie. And at which point I think we will then start a long descent back towards that 100 level. So with these things happening, which I think they will, what happens with risk? What happens with stocks? Well, again, I'm going to repeat myself. I think this is going to give support to stocks, and the S&P, yes, is down today, but as long as we're above this area of support here, which is around between 44.30 and 44.60, let's say, I still think we're on an uptrend, and technically we are still on an uptrend. Higher highs, higher lows. No change to that. So I would suggest that trying to pick a top here is going to be dangerous. Now we are seeing a correlation break today. So we're seeing bonds rallying and stocks selling. So this in the recent years has not been the base case of correlation between the two, but you can't make a pattern from one day's price action. But this is what we're seeing today. So for the S&P, as long as we're above this area, I wouldn't change my bias at all. And I think that the CPI on Thursday is going to give us the next direction. So we either break below here on a strong number, also higher than expected inflation, or we go back towards these 4,600 highs on a weak number. Again, my prediction or my balance of probabilities is that the inflation print is going to be lower than expected. I wouldn't be surprised if it comes in flat. So if this month-on-month reading is 0 and the year-on-year comes in flat to the last print. So again, we talk about risk. We have to talk about cryptos, which have been a very, very good proxy. And you have to admit that with the exception of this spike due to the ETF, that was the BlackRock ETF, Bitcoin has been underperforming. And it's not really trading in a way that inspires confidence. Of course, you could say that, impulsive move, kind of flag, bullish flag, but this is, this is starting to look a little bit too stretched out and not as nicely symmetrical as you would like to call this a flag. So I'm not convinced at the moment. that cryptos are going to be going to the moon. Having said that, if what I think happens with yields and the dollar and equities in general, they're going to most likely follow suit to the upside. But again, underperforming risk, so underperforming equity indices, in my opinion. Pretty clear levels at the moment. So, 28.5 to the downside is the first level, which is quite close. 32 on the upside, which is not that close. But we've seen cryptos, we've seen Bitcoin doing 10% in a day easily. Currency-wise, well, the euro is the opposite of the Dixie, so I'm not going to talk about that. I still think the UK, even though they have I don't want to call it names, but a different central bank than other countries, so they're a little bit different. They're always dovish whenever they can. I still think that they have a little bit more to do than the Fed, definitely, and most likely the ECB as well. Remember, the economic data out of Europe have been pretty weak, especially from Germany. So, it doesn't matter if you have Greece outperforming, it's only a tiny part of the Eurozone. So I think that Euro pound is still bearish as long as we're below 87.2. We are in no man's land now, so I wouldn't suggest shorting it out right here. But if we get towards 87, actually 87, nice round number, I think I'm going to try and short that with a relatively tight stop above. The scalper in me will rise again, I think. But my view for the pound is still constructive. At least for the rest of the year. I'm not saying that the UK is going to be firing on all cylinders, far from it, but I'm still constructive. Similar story for the pound. I don't know how relevant this trend line is anymore, but we are toying with the 50 DMA. We found relatively good support. Well, actually very good support at this 38.2 from the highs. I did take a stab. Not at 26.30, at 26.39, took 60 pips, got out. I'll be looking to buy dips again, provided that the economic situation in the UK has not changed dramatically. So that's for the pound. It's still from the three majors. Funnily enough, it is still my favorite from the dollar, the euro, and the sterling. Norway. It's one I keep looking at. Remember, I missed this breakdown. I was away. Unfortunately, I missed that. So a retest of this, I will definitely look to sell again on the Euro Norway. And this head and shoulders did play out well. Didn't actually fulfill the target, which was probably closer to this fib down at 1085, but it still broke down quite convincingly. Dollar Norway, similar story. Actually, it looks like a very impulsive move lower. Kind of bearish flag forming here, or a wedge, or whatever you want to call it. The 200 DMA, we moved off that really nicely. I will probably look to sell this on a retest. Maybe we get that on Thursday. But another one I'm watching at, which I want to be short if I want to short dollar pairs. It's one of my favorite ones still. Let's have a look at metals as well, shall we? We like metals. So gold is close to this trend line again. 1, 2, 3, 4 touches. It seems to be holding for now. The big level it really is 1895. If we break this, this is really the level we want to be watching. And 1985 on the upside, really no change on that. Still within a range between these two, chopping around. And for a quick trade, I think not a bad idea to be trying to play off this support trend line with a tight stop below, but I don't know if I'm going to do that. Silver did really nicely. Well, really nicely. It's still holding that 200 DMA. I bought back my third position, which I had sold at around 24.50. I bought it back yesterday, and my average is 23.13. So basically, full position long now at these levels. I like the look of that. Nice to have banked about 6% on a third of the position, and to have it back on now. So I like to be nimble, and I'm not saying that it's looking all rosy now for metals. Far from it. With yields dropping, I would have thought that gold and silver will be doing better today, but they're not. But on the other hand, fundamentals. Sorry.
I think it's all a China trade today.
It's also the CNY, right?
Yeah, it's all a
yes.
China trade today. I think in whether it's metals, yields, stocks, it's all one pot today. Since China broke up, I think China is your word of the day. If you look at why we are moving in certain directions today.
Yeah. And and you know, with the general macro environment that I see, which is low rates, inflation subsiding, tightening stopping, well, I don't see why metals shouldn't resume higher. So I've built up my full position. As I've said before, when I had my full position before, this is one of the rare times where I'm going to add more and have more than one full-size position on this. If we get back towards the low 22s, I think I'm going to start adding a little bit more. I feel very, very confident about this trade, and I am unleveraged, as everybody knows, I think by now, and my stops are very, very generous. And my horizon is very, very long. So I don't mind having a little part of my portfolio. Actually, no, it's becoming bigger now. A substantial part, let's say, of my portfolio on this, which I really, really like for the medium term. So I'm very patient, and I like the trade. Oil, excuse me. Oil is well, this support zone really held well. We are now near the highs of this, you know, what is almost a 1 year range between 83 and, you know, 63. Don't know what to do with this. I really don't. I mean, if you put actually, no, I'm not going to say guess because it's going to be a guess. I don't know how to trade oil. Thank you very much. Yeah, that's it. So
Cool.
we wait for Thursday for more information. And I tell you what, you know, we could see a change, you know, especially if we get a big, strong number from inflation. I think that can change a lot in the macro environment. So I'm not expecting that, but I think it's going to have a strong number. Is going to have a bigger effect on markets than a weak number. I'll leave it at that.
Yeah, thanks, mate. Just before I hand it over to UK, just answer another question from Horatio. In the case of a CPI miss this Thursday, would you also look to fade the dollar since there's another CPI and another NFP before the next meeting? If this one beats, could markets look forward to the next one and sell the US dollar on expectations that the next CPI will continue to trend lower? I don't know because, oh, you're taking the screen. Okay. I don't know.
Do you want to hand it back?
No, you're right. Because I think if you're going to trade these data points, unless you've got a long-term view or a long-term plan already in place in terms of what inflation is going to be doing, you just trade around the data as it comes, and you have to know what the market is doing going into it. If the dollar is strong going into Thursday's CPI report, and you get a strong number, higher than expected, so it comes in 3.4, 3.5, 3.6. Because the dollar's already strong, you're going to get further fuel to that fire. Now, as Kay mentioned, the bigger price move will be if inflation is much higher than expected. So you're already adding to an already ongoing move, i.e. dollar strength. What you do in that situation is you say, right, you pick your pair. If we see some dollar strength, what levels have we got to break, or what levels will I be happy to trade against it for a potential fade? For something like dollar yen, it might be into 144, maybe even 145, depending on where we are. So then you look at your big levels and you say, right, even if this data is strong, even though the dollar trend is strong, it's got to break these levels. And the same works on the other side. You know, if the CPI comes in soft, the market's probably going to have a bit of reaction, depending on how soft it is, because there will be a difference in expectations. So the market will likely move on that. But if it's lower than expectations, so we're expecting 3.3, if it comes in at 3.3%, the market will go, fine, the Fed will remain on pause. And that's the mood and the sentiment that was already in place before the data. So there's not likely to be that much trade on that side. But I think for now, you can't really trade today's data point against next month's data point against the next NFP, because it's too far away and there's too much water to go under the bridge, unless you've got a longer term trade on, a longer term plan in play which you can then adjust around data. So anyway, that's my thoughts for trading the CPI. Pick your levels, see if they can break or not. Over to you, mate.
Yeah, I just wanted to show, because when you see all those other dollars moving, like the Aussie, the Kiwi, the dollar yuan, the yen as well overnight, and one wonders what euro dollar is doing here. This is it, you know. I keep on banging on about it, but this is it. Your euro and US yields are very much locked in together right now. So yes, we are going to see moves, but the moves may be more interesting on euro crosses, for instance, which may run in line with what the dollar pairs are doing, rather than diving straight into the euro dollar. Although it must be said that today we are below yesterday's level on the euro dollar. It looks a little weaker, and that despite those yields coming off. But then we're coming back to this one. They're all in lockstep with one with the other. So when the dollar yields come off, the euro yields also come off. And today I reckon it's all about what's happening there in China. And Stel was pointing at it. Yields are coming off, but the equity markets are also coming off. The metals are, especially I would say silver, still not feeling too well, because as we know, silver is an industrial metal. So if things are not bright in one of the engines of the world economy, silver will probably underperform gold. We have already spoken about that. So dollar yuan finally made up its mind. We broke successively through the 720.5, 721.5, and 722, which what I was looking for a new impulse, and I've traded it. So I reckon this now means that at least investors are saying, like, well, it's perhaps not yet time to buy that yuan. And I think there's a possibility now that we are going back to these highs for a starter around 728, and why not over time, depending on what the PBOC will do, back to those prior highs. For those who weren't in F.A.C.E yesterday, the last minute of F.A.C.E, they asked me about the dollar Hong Kong peg, and while looking at this dollar CNH, a year or so ago, I was saying, or 2 years ago, and Ryan remember that, I was trying to play the break of that dollar Hong Kong peg to the downside, which never happened. And because I thought that, okay, China is taking control back over Hong Kong, so probably they will want to align their currencies, which did not happen at all. But what we've seen since is that actually the Chinese yuan is catching up on the dollar Hong Kong. So I'm not going to make that call right now because it's far away. But you know, the dollar Hong Kong peg is 775 to 785. Dollar China is trading CNH. Then the thing that we can trade is trading 723. That is another 7% away. But you know, in the markets, never say never. So if things go badly, really badly in China, why not starting to push up closer to this dollar Hong Kong? There, I've said it. That for as long as we hold above those 7 levels also. That is one that I was looking at. I am not going to chat too much about the rest. On the dollar yen, the only thing we have to note is really that we are back back above the cloud. If the market would have confidence in the yen, it would at least trade inside the cloud, but we're trading a little bit above. So Japanese are watching that, you know that. And then in the shorter run, there is a bit of activity here, undeniably, between 143.40 and 143.85.90, and I think that's your stop or your gateway to 145 again. I'd say that in the current context, we may not have enough strength because those US yields and other yields are coming back down, and the equity markets, commodity markets are looking a little bit reddish. Like Simon already indicated in the room, you look at copper, you look at oil coming off. It's a bit of a sea of red there in the commodities land. Usually, that does not support a weaker yen, but you know, I mean, there's this consideration about what Japan wants to do with its JGBs as well, and Mizuho poured quite a bit of cold water on expectations, for what I'm concerned. Yeah, we have to look at one that is really under the cosh due to this Chinese situation as well, and also because we have seen those attempts to reopen and relax how shall I say, trade restrictions between Australia and China. And the more we get those trade restrictions taken away, it's going to be a bit of a double-edged sword on one hand, because it should be good for Australia if they can trade more with China again, but it also makes them more vulnerable to what's happening in China, right? And I think that is what we are seeing here, this falling out of bed on the Aussie. It looks weak. It does look weak to me. This if you don't retake 65.5 pretty soon, that Aussie is probably in for another 50-60 points lower. So that for what's going on today in the advent of Thursday's US CPI. I think we are mainly trading China today, and we can see it as well on stuff like sterling Aussie, sterling, which is relatively stable versus euro, for instance. So the sterling is running together with what's happening in Euroland, euro sterling stable, and sterling Aussie broke above the wedge. Some of us are trading this. We held this support line. It is trading higher. I reckon there is a fair chance we are going to have a look at what's happening up here, anywhere into the 196.75, 97, stretch it up to 198, which is also the target zone of some harmonics that some people in our chat room are showing. Guys, if you're not in our chat room, you're really missing out on some really great ideas and really great shows. I mean, chart being showed and directions being showed by not only us, you know, I mean, the whole of our community is contributing to this. So if you're not in there, you're missing out. Back to you, Ryan.
Thank you very much, mate, for your valued input. Let me just grab the screen back quickly. Yeah, I've been looking. I keep half an eye on the Hong Kong dollar because I was shorting it up at the top of the band. For those that don't know, it is locked into a band 775, 785.
We don't see it, screen, right?
Oh, bloody hell! We get this bloody problem again.
We can hear you clicking, but we can't see the screen.
Yeah. Anything now?
No.
Oh, for fuck's sake.
Yeah, okay, it's okay. We're at the end, right?
Yeah,
So
right. Anyway, it's not. You don't need a chart to visualize it. We're sitting bang in the middle, pretty much, of the band for the Hong Kong dollar. I stopped trading this because they put the bloody margins up on it for some stupid reason. Ridiculous margins. So I didn't bother trading it anymore. But I might have a little look, see if those have come down yet. Right, what else we got? Not a lot really, seems I can't show the charts. So I think we'll call that the show for today. What have we got coming up? Not a lot on the data front. Nothing. Wholesale sales and inventories later on. Just keep an eye on those to see for their economic activity usage. Other than that, thank you to the two guys here. I'm not going to say their names for favoritism reasons. Have a great day, everybody. We'll see you all tomorrow. Thank you very much.
Thank you, guys.